Imagine walking into a marketplace where there are no stalls, no merchants, no middlemen shouting prices. Instead, the market itself is the merchant. You place an item down and instantly, almost magically, you're given something else of equal value. No negotiation, no waiting, no human in between. Just a system that works on its own, 24/7 for anyone, anywhere. That's the experience Uniswap created for finance. Before Uniswap, if you wanted to trade cryptocurrencies, you had to use a centralized exchange. That meant trusting a company to hold your funds, manage your trades, and honor your withdrawals. For many, this worked, until it didn't. Hacks, scandals, and collapsed exchanges reminded users that when you trust the middleman, you also inherit their risks. Uniswap flipped that script. Instead of going through a company, Uniswap lets people trade directly with a smart contract on Ethereum. There's no custodian. No one holding your assets on your behalf. The code itself facilitates the exchange. You connect your wallet, pick your tokens, and the system matches your trade instantly. It's not a company running an exchange. It's a protocol enabling one. This was revolutionary because it solved one of crypto's biggest contradictions. The dream of decentralization kept colliding with the reality of centralized trading. People wanted to own their keys, but they also wanted the convenience of liquid markets. Uniswap bridged that gap, and it did so with an elegant idea: automated market makers. Instead of relying on order books with buyers and sellers constantly updating bids, Uniswap uses pools of liquidity provided by users. Anyone can deposit 2 tokens into a pool, and the pool itself becomes the counterparty for trades. The pricing is set by a simple mathematical formula, and the pool rebalances automatically as trades happen. This simplicity unlocks something bigger: participation. Suddenly, anyone could be a liquidity provider. You didn't need to be a market-making firm with sophisticated bots and millions in capital. You just needed a wallet and some tokens. For the first time, liquidity provision became democratized. The timing couldn't have been better. As decentralized finance began to rise, Uniswap provided the plumbing, the infrastructure that allowed tokens to flow and value to move without centralized gatekeepers. DeFi apps, NFT projects, and countless experiments in tokenization all leaned on Uniswap as the marketplace where liquidity lived. But Uniswap's story isn't just about technology, it's also about trust and philosophy. By removing the middleman, Uniswap embodied the spirit of crypto: open, permissionless, and global. Anyone, anywhere, at any time could use the protocol. There was no sign-up, no verification, no waiting period, just connection. And yet, its rise also sparked questions. Could AMMs really replace traditional exchanges? Could liquidity pools scale to handle billions in volume? And what about the risks? Impermanent loss for providers, front-running by bots, and the challenge of governance as the protocol grew. Uniswap's story begins not with a corporation or venture capital firm, but with one developer and an idea that almost seemed too simple to matter. Hayden Adams, a relatively unknown software engineer, lost his job at Siemens. With free time on his hands and a curiosity about Ethereum, he began tinkering with Solidity, the language of smart contracts. Around the same time, he came across a concept proposed by Ethereum's co-founder, Vitalik Buterin, the automated market maker. Vitalik had outlined the math, but no one had yet turned it into a functioning platform. Adams decided to try. What began as a personal experiment became the seed of a protocol that would reshape decentralized finance. Adams built a proof of concept for a system where users could swap tokens directly from pools of liquidity, rather than relying on traditional order books. It wasn't polished, it wasn't funded, but it worked. And in crypto, that's often enough for something to catch fire. Uniswap was live on Ethereum. Its design was stark in its simplicity: no order books, no market makers adjusting bids and asks, just liquidity pools where anyone could deposit 2 tokens of equal value. Trades happened against these pools, and the price was set by the formula X(Y)K, a constant product equation. It was math, not middlemen, that determined value. This simplicity reflected Uniswap's vision. Adams didn't set out to build a company. He wanted to build a protocol that lived on Ethereum, open to all. The ethos was permissionless access. No one needed approval to trade or to provide liquidity. No one could be blocked or censored. The system didn't care if you were a billion-dollar hedge fund or a student with $50 in tokens. The rules were the same for everyone. That vision mattered because it aligned with the spirit of decentralization. For years, crypto users had complained about the irony of centralized exchanges dominating a decentralized industry. People believed in not your keys, not your coins, yet still trusted exchanges to hold their funds. Uniswap was a chance to break that contradiction. The protocol also carried a democratizing impulse. Traditional finance has gatekeepers at every level: exchanges, brokers, clearinghouses, banks. Uniswap replaced those with code anyone could inspect. In doing so, it gave ordinary users the chance not just to trade, but to become liquidity providers and earn a share of fees. Finance, in other words, wasn't just for the big players anymore. Uniswap's early success wasn't measured in billions of dollars. It was measured in the sense of possibility. Here was proof that decentralized markets could work at scale without companies, without order books, without permission. The vision that guided Uniswap was both modest and radical. Modest because it relied on a simple formula and an open-source ethos. Radical because it dared to suggest that one of the most fundamental structures of finance, the market itself, could be automated, decentralized, and made available to anyone with an internet connection. But ideas alone don't sustain momentum. The question was, could Uniswap's design scale? Could it really handle the growing demand for decentralized trading? To answer that, we need to dive into the technology and architecture that powered Uniswap's rise. Uniswap's genius lies in its simplicity. It took the centuries-old idea of a market, buyers, sellers, bids, asks, and replaced it with an equation. At its core is the automated market maker, AMM model. Instead of matching individual buyers and sellers, Uniswap uses liquidity pools. Anyone can deposit 2 tokens of equal value into a pool, for example, ETH and USDC. Once deposited, that pool becomes the counterparty to all trades. If you want to swap ETH for USDC, you trade directly with the pool. The pricing comes from a deceptively simple formula: XXY how yas K. Here, yas X is the amount of one token, Y is the amount of the other, and K is a constant. This equation ensures that the product of the 2 token amounts always stays the same. When a trade happens, it shifts the balance of tokens, and the price adjusts automatically. This design eliminates the need for order books, which require constant updates and active market makers. Instead, liquidity is always available and prices update seamlessly as trades occur. It's like a self-adjusting seesaw. As one side goes down, the other rises to maintain balance. But the AMM model only works if there's enough liquidity. That's where liquidity providers come in. By depositing tokens into pools, LPs enable trading. In return, they earn a share of the transaction fees. This incentive model turned ordinary users into market makers. Suddenly, anyone with spare tokens could provide liquidity and earn passive income, something once reserved for sophisticated trading firms. Over time, Uniswap refined its technology. Uniswap v2 introduced direct ERC20 to ERC20 pools, meaning users no longer had to route everything through ETH. It also added price oracles to improve reliability for other DeFi protocols. Then came Uniswap v3, a major leap forward. v3 introduced concentrated liquidity, allowing LPs to allocate funds within specific price ranges rather than across the entire spectrum. Imagine running a lemonade stand. Instead of being open 24 hours and wasting resources when no one's around, you focus on the hours when demand is highest. Concentrated liquidity works the same way, letting providers use their capital more efficiently. This dramatically improved trading depth and reduced slippage, making Uniswap competitive even with centralized exchanges. Security is another pillar. Uniswap is built on Ethereum, inheriting its security guarantees. Smart contracts are open source and audited, but as with all DeFi, risks remain, from coding bugs to exploits. Still, Uniswap's reputation for resilience has made it a trusted building block for other DeFi protocols. Beyond the contracts themselves, governance is handled through the Uni token. Uni holders can vote on protocol upgrades, fee structures, and treasury spending. This gives the community a voice in the platform's future, though debates continue about how decentralized governance truly is in practice. Together, these features, AMMs, liquidity pools, incentives, concentrated liquidity, and governance, form the backbone of Uniswap's architecture. They make it not just a trading app, but a protocol, a set of rules and contracts anyone can plug into. But the real test of any architecture is adoption. How widely is it used? How has Uniswap shaped the broader DeFi ecosystem? That's where the story becomes even more compelling. Uniswap didn't just introduce a new way to trade tokens. It became the foundation of decentralized finance itself. From the moment it launched, Uniswap attracted attention because it worked. Early users could swap tokens instantly without waiting for a buyer or seller to appear. That reliability, combined with low barriers to entry, quickly made Uniswap the go-to platform for trading new Ethereum-based tokens. When DeFi projects launched their tokens, Uniswap was often the first place they appeared. This gave Uniswap an outsized role in the rise of DeFi. Lending platforms, yield farms, and stablecoins all depended on liquidity, and Uniswap provided it. By becoming the default marketplace for ERC20 tokens, it positioned itself as the plumbing of decentralized finance. If DeFi was a city, Uniswap was the water system, invisible at times but essential to everything else. Adoption accelerated during the DeFi summer of 2020, when yield farming and token launches drew massive attention. Billions of dollars flowed into Uniswap's liquidity pools. Users weren't just trading, they were providing liquidity, earning fees, and experimenting with financial systems that felt open and alive, in a way traditional markets did not. Beyond speculation, Uniswap also proved its value in more practical ways. Stablecoin swaps became a key use case, allowing people to move between different dollar-pegged assets quickly. NFT creators and DAOs used Uniswap liquidity pools to bootstrap their tokens. Arbitrage traders relied on its pricing mechanism to balance markets, and developers built on top of Uniswap, integrating it into wallets, dApps, and payment systems. This added a political layer to the technical system, turning Uniswap into a community-driven protocol rather than a static piece of code. By 2021, Uniswap had become one of the largest exchanges in the world, centralized or decentralized, processing billions in daily volume. Its role in the crypto economy was undeniable. Traditional exchanges listed hundreds of tokens, but Uniswap listed thousands, because anyone could create a pool. This openness turned it into a launchpad for innovation, though it also raised questions about scams and low-quality tokens flooding the ecosystem. Institutional interest began to stir as well. While centralized exchanges remained the entry point for many, financial firms started to recognize Uniswap's potential as a model for decentralized liquidity provision. The protocol wasn't just a quirky experiment. It was proof that markets could exist without middlemen. Today, Uniswap remains a cornerstone of Ethereum's ecosystem and beyond. Its contracts are integrated into countless dApps. Its pools are used as oracles for pricing. Its brand has become synonymous with decentralized trading. But adoption also brings new pressures. Can Uniswap maintain its dominance as competitors like Curve, SushiSwap, and even centralized exchanges adapt? Can it scale beyond Ethereum's limits, especially with rising gas fees? These are questions that define its future. Before we look ahead, though, we need to examine the friction points, the criticisms, challenges, and risks that come with Uniswap's open model. For all of Uniswap's achievements, it has not been free from criticism. In fact, its success has only amplified the questions around whether decentralized exchanges can truly compete with traditional financial systems. The first challenge is scalability and cost. Because Uniswap runs on Ethereum, every trade requires gas fees. In times of congestion, those fees can soar to tens or even hundreds of dollars per transaction. For large traders, that's an inconvenience. For smaller users, it's a deal breaker. High fees risk turning Uniswap into a playground for whales, leaving ordinary users behind. Layer 2 solutions and cross-chain deployments are helping, but the tension between Ethereum's limitations and Uniswap's ambitions remains. Another issue is impermanent loss. For liquidity providers, the promise of earning trading fees sounds appealing. But in practice, the value of their deposits can decrease compared to simply holding the tokens. When token prices shift significantly, LPs may find themselves worse off despite collecting fees. For many users, this risk is confusing and discouraging, raising questions about whether liquidity provision is sustainable for the average person. Uniswap also faces competition. While it pioneered AMMs, rivals like Curve, SushiSwap, and Balancer have carved out niches with different models. Curve, for example, specializes in stablecoin swaps with lower slippage. SushiSwap attracted communities with incentives. Even centralized exchanges are borrowing DeFi ideas, offering staking and on-chain-like products with smoother user experiences. Uniswap remains dominant, but the landscape is crowded and fast-moving. Front-running and MEV, minor extractable value, present another challenge. Because trades are visible in the Ethereum mempool before they're finalized, bots can jump ahead of large transactions to profit from price changes. This creates an uneven playing field where ordinary users lose value to automated actors. Efforts are underway to mitigate MEV, but it remains a structural issue in decentralized exchanges. Then there's the governance dilemma. Uni token holders technically control the protocol, but in practice, voting power is concentrated among a small number of large holders, including venture capital firms. Critics argue this undermines the spirit of decentralization, turning governance into a symbolic exercise rather than a truly democratic process. Balancing efficiency with fairness in governance remains an open question. Regulation adds yet another layer of uncertainty. Uniswap is a protocol, not a company, but regulators are increasingly scrutinizing DeFi. Concerns about money laundering, securities laws, and consumer protection could bring legal pressures. Because there's no centralized entity to shut down, regulators may target developers, interfaces, or governance participants. How Uniswap navigates this regulatory gray zone will shape its future. Finally, there's the user experience gap. While DeFi enthusiasts are comfortable connecting wallets and approving transactions, mainstream users often find it confusing or intimidating. Without easier interfaces and educational efforts, Uniswap risks remaining popular within crypto circles but inaccessible to the broader public. None of these challenges are fatal, but together they highlight the fragile balance Uniswap must strike. It has proven the concept of decentralized trading, but sustaining and scaling that vision requires constant innovation, adaptation, and dialogue with both users and regulators. The question then is not whether Uniswap has changed finance. It already has. The question is whether it can continue evolving to remain at the center of DeFi as the ecosystem matures. If the past few years proved that decentralized exchanges can work, the future of Uniswap will be about proving they can last. Its next chapter depends on whether it can scale, evolve, and integrate into a broader financial system that is still largely centralized. One clear path forward is multi-chain expansion. Uniswap has already deployed beyond Ethereum onto Layer 2 networks like Optimism, Arbitrum, and Polygon. These rollups and sidechains lower costs and speed up transactions, making Uniswap accessible to users priced out of Ethereum mainnet. As new chains emerge, Uniswap's ability to extend across ecosystems will determine whether it remains the default AMM or becomes just one of many options. Another frontier is cross-chain interoperability. Today, liquidity is fragmented across blockchains. If Uniswap can become a hub that allows seamless swaps across chains, it could solve one of DeFi's biggest bottlenecks. Cross-chain bridges and new designs like shared liquidity layers may make this possible. Imagine swapping Bitcoin for an Ethereum-based stablecoin without leaving Uniswap. That's the kind of future integration that could cement its dominance. The evolution of liquidity provision is also key. Concentrated liquidity in Uniswap v3 showed that efficiency matters, but it also added complexity for LPs. Future versions of Uniswap may focus on simplifying these tools or automating strategies so everyday users can participate without needing advanced financial knowledge. If Uniswap can make liquidity provision both profitable and user-friendly, it will keep the ecosystem vibrant. Institutional adoption could play a major role too. Banks, funds, and fintech companies are increasingly exploring blockchain. Uniswap's transparent, rule-based markets may appeal to institutions seeking neutral infrastructure. But institutional interest will require regulatory clarity, robust compliance tools, and perhaps hybrid models that balance openness with oversight. Governance will continue to evolve. Today, Uni token holders shape decisions, but governance is still criticized for concentration of power. Future iterations may experiment with new voting systems, delegate structures, or quadratic voting to balance influence. If Uniswap can refine governance into a more inclusive and efficient system, it may become a model for decentralized organizations beyond finance. Of course, regulation looms large. Governments around the world are grappling with how to handle DeFi. Uniswap, as a leader, will be at the center of these debates. Its challenge will be to defend openness while engaging with regulators in a way that preserves user freedom. How it navigates this tension could determine not just its future, but the trajectory of DeFi itself. In the bigger picture, Uniswap's future may not lie in competing with centralized exchanges, but in complementing them. Centralized platforms may remain entry points for many users, but Uniswap offers something they can't: neutrality, transparency, and permissionless access. As trust in centralized institutions wavers, these qualities may become even more valuable. If Uniswap succeeds, it won't just be a protocol for swapping tokens. It will be part of a financial system that runs on rules, not rulers, where anyone, anywhere can trade and provide liquidity without asking permission. That's the promise. And it leads us to the final question. What does Uniswap mean for the future of finance, and why does it matter for all of us? When we look back at Uniswap's story, what stands out is not just that it built a successful protocol, but that it redefined what a market could be. Before Uniswap, trading meant trusting an intermediary, a centralized exchange, a broker, a custodian. The idea of removing all of that and letting a piece of code handle trades seemed radical, even naive. Yet Uniswap proved it possible. With nothing more than liquidity pools, a simple equation, and an open-source ethos, it created a functioning marketplace that operates around the clock for anyone with an internet connection. That accomplishment matters because it shifts the balance of power. Traditional finance is structured around gatekeepers, institutions that decide who gets access, when, and on what terms. Uniswap bypassed them. It doesn't ask for permission, it doesn't discriminate. It doesn't shut its doors on weekends or freeze accounts during volatility. It just works openly, predictably, and impartially. This is why Uniswap feels less like an app and more like infrastructure. It has become plumbing for decentralized finance. Other protocols plug into it, projects launch on it, and users rely on it daily without always thinking about the machinery behind it. Like the internet itself, its power comes from being invisible until you need it, and indispensable once you use it. At the same time, Uniswap's journey reflects the growing pains of decentralization. It showed what's possible, but also where the cracks appear. High fees during congestion, risks for liquidity providers, governance power concentrated in a few hands, and vulnerabilities to front-running and MEV. These are not signs of failure, but reminders that building fair, open systems is hard. Every step forward reveals new challenges to solve. And yet, Uniswap endures and evolves. From V1's humble pools to V3's concentrated liquidity, it has adapted, refined, and scaled. It has expanded beyond Ethereum's mainnet to new chains and layer 2s. It has grown from an experiment by one developer into a protocol that processes billions of dollars in daily volume. Few projects embody the spirit of open-source innovation as clearly. The deeper lesson of Uniswap may not be about trading at all, it's about trust. It asks us to place trust not in companies or institutions, but in transparent rules encoded on-chain. It shows that markets can run without managers, liquidity can be provided by communities, and innovation can be shared rather than owned. In a world where financial systems often feel fragile or opaque, that's a profound shift. Looking forward, Uniswap's importance may not be measured by how many trades it handles, but by what it symbolizes. It's proof that finance doesn't have to look like it always has, that alternatives exist, that a protocol can become the backbone of an economy without needing a boardroom or a CEO, and maybe that's why Uniswap resonates. It reminds us that decentralization is not just a technical buzzword, but a practical philosophy. The belief that people can build systems where power is distributed, access is open, and rules are clear. So when we ask, what is Uniswap? The answer is simple but powerful. It's not just a tool to swap tokens. It's a glimpse into a world where finance is no longer controlled from the top down, but shaped from the bottom up. If it continues to succeed, Uniswap won't just be remembered as a DeFi protocol. It will be remembered as a turning point. The moment we realize that markets themselves could be decentralized, and that the future of finance might belong not to institutions, but to protocols and the people who use them.